Hello, friends. Welcome to this monthly market update from Myna Manulife Mutual Fund. As we start this month of March, let's review what happened in Feb. And the most notable event for the month of February was A, the budget, and B, the regulatory action by the monetary policy authorities, notably US Fed and RBI. Budget, we would have spoken in the last conversation, but net the growth orientation of as they maintained by budget. Coming to monetary policy, both US Fed and RBI announced their continued intention to have some sort of a fear of inflation guiding their monetary policy. And to that extent, one is possibly in a situation where higher interest rate for a longer tenure might just play out to be the theme for entire CY23. The way the commentary from both the banks have played out in the month of Feb. What does one look at from a business perspective really is that, while interest rates are likely to remain high, what one sees is the asset price valuation across asset classes, equity, debt, trying to adjust itself to the new interest rate regime. Higher the interest rate available, perhaps the risk factor or risk acceptance by investor changes is a theory. Let's see and understand how it plays out in this particular calendar year, whether the flow of investor money towards riskier asset class like equity, like maybe real estate, etc., play out vis-a-vis the fixed income investment. It's something which we will see over next 6-12 months in terms of investors' behavior. Coming to pure economic markets, economic does reasonably okay at 4.6% GDP growth rate for Q3, more or less in line with what RBI had been guiding us. So I think those things are on track. Quarterly results for Q3 FY23 have been again more or less on track with banks leading the show. Possibly one of the best results have come in for banking sector in this quarter. While the firepower of higher interest rates giving them profitability is still there. Sometimes in next 6 months we'll start worrying about how interest rate as I expect starts going up for them. Because someday they have to learn to share the higher interest cost as a part of their liability, so that the depositors start giving them more money. To an extent, that's one thought on the banking space. Clearly, rest part is broadly in place. Whatever the government intends to do, corporate capex cycle reasonably on track. One notable area of slowdown or worry is actually the discretionary spend. Because to an extent, it's something different. On a very positive note, it's possibly saying that now that everybody is back to work, people do have less time to spend on discretionary stuff. So to an extent, something lower there. Other side is somewhere the higher interest rate, which are now by 250 basis points in last 9 months or so, are hurting the consumer disposable surplus. So it's too early to really figure out which of the two is more dominant trend. But at the same time, it's something which we've observed and like to share. While we meet again next month, I think the broad direction remains the same. Equity markets had a great run. Might be some case of some breather for 3-6 months, especially where asset allocation driven by interest rate and asset class choice plays out. It's like we leave aside this 3-6-9 months and focus on 2-year, 3-year, 5-year. Equity remains a preferred asset class. The macro story of India gaining GDP rank from 6th or 7th to 3rd over next 3-5 years does not change. And as we know, economic growth creates wealth for all of us. So here is happy investing for that long term, which we all would like to participate. That's all for me. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.